Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Josh Lloyd and Joe Ashkouti, founders and owners of Yieldi. This is a unique lender based in Atlanta. We've been doing business with them since 2020. They lend primarily on commercial real estate, but also residential investment properties, typically bigger deals, average of a few $1,000,000 and maybe up to $20 million. They're also one of the few lenders in our network that are currently funding land loans for experienced developers with a clear exit strategy. As with most of my interviews, we started off talking about trends that they're seeing in the market, what the loan requests are getting as of now in June 2025. We talked about their guidelines for commercial properties, for residential investment properties, rehab loans, ground construction loans, and land loans. We talked a little bit about their company and also their unique capital structure. I hope you find this episode to be insightful. Let's get started. Here's my interview with Yieldi. All right, gentlemen, thank you for joining me for this episode of Private Lending Insights. We're here to talk about Yieldi. Let's start off by talking about what you're seeing in the market in terms of the loans that you're doing and the loan requests that you're getting.
Yeah, thanks for having us, Rocky. We're now, I guess, in the second quarter of 2025, and I would say that our pipeline of leads that we're seeing is probably as strong as it's ever been. A little bit of that is because of us with our marketing efforts. A little bit of that is because we've created a reputation for being able to look at any kind of loan, whether it's on the residential or on the commercial side of the business. But either way, the flow of leads has been a lot, and so that's kind of exciting. A lot of the deals are deals that are not necessarily great, but that's just part of the business. But overall, yeah, we're seeing big influx of deals.
Yeah, just to touch on that, we are in our 6th year of business. We started the company in 2019, and I feel like the market as a whole we've grown with. When we first started, the market was maybe $1 billion. Now I feel like it's multiple billion. And so when we first started the business, our average loan amount was between $300,000 and $500,000. Today, our sweet spot is between $1 and $10 million. We just closed a deal the other day that was $17.5 million. So we're really excited about the future of the private lending space.
And with all the things that have been going on in the market, maybe let's just say not the last year, let's talk about the last 6 months. What are some of the unique things that you're seeing as far as loan requests coming in or defaults or anything you can tell us?
Yeah, I would say we're seeing a lot of land deals, which, aren't the sexiest loans for lenders, but we find a way to get them done. I mean, a lot of these guys, these developers aren't able to get construction loans because of the market. And so they need a bridge to get them to be able to close on the land until either construction costs come down or rates come down a little bit so they can, or banks loosen up in order for them to get a construction loan. But so we've been a good source for a lot of developers on the land side of the business in the last 6 months. I mean, that's probably a majority of the deals that we're getting right now.
Yeah, and I think, overall, as I mentioned at the top, because we look at residential, we look at commercial, we're able to see a little bit of trends just within the deals that we see. I think, storage is an interesting space right now. I think just because of what's going on in the housing market and storage maybe is being a little bit less utilized, I think that's causing a little bit of a downward price point for those guys. And so getting those deals done has been a little bit harder as of late. I would say over the last few months, we've had to reprice deals based on appraisal, brokers' opinions and values, lots of conversations in that space. Interestingly, though, with a lot of talk around the lower end housing market and especially, the bigger builders and what they're doing right now. I just read an article today. They're offering incentives and discounts to move houses, trying to kind of offset the interest rates that are out there right now. The guys that are in the $1 million to $2 million plus more luxury home markets, they're actually doing pretty well. I think the buyers are less price sensitive. And that bodes well for us because that's an area that we like to play in, especially in the Southeast where we're based out of in Atlanta. We understand the market really well. South Florida is another area that's kind of interesting, going through interesting times right now. But That market seems to be doing well. Properties seem to be moving at a pretty good pace still. So we like that a lot.
To touch on that, the industrial market is still feels like the darling of the dance. Everybody wants to get into the data center game, and so we're seeing a lot of we're not seeing those types of deals because those are larger deals, but it seems like a buzzword lately.
Yeah, the smaller industrial stuff that we do get an opportunity to do is a little more competitive than it used to be, I would say, with other lenders kind of jumping into that world. But yeah, we do like dealing with those a lot as well. And from a default perspective, historically we we live in an interesting space, Yieldi does, because we don't really compete very well on the, I think it's called RTL now, or fix and flip space. We do them, they come up here and there, but it's not our bread and butter by any means. We're very, very conservative by nature as an organization, and especially when it comes to loan to value, loan to cost, construction budgets, that type of thing. There's a lot of other people who have figured out a different model where they're, 90%, 100%. We can't really touch that. Well, what that means for us is that our default rate's been really consistent over the 6 years we've been doing this. We haven't seen anything go crazy this year, during COVID, anytime in between, really. I think, as long as we stay in our sweet spot of 60 to 70% LTV lower on land, obviously, we don't get ourselves into too much trouble. Our borrowers have a lot of equity in these projects. Um, they'll work out a forbearance agreement if they need to. The last thing they're going to do is get foreclosed on these properties. So those numbers remain consistent and low for us.
And how about bridge to bridge? Have you been seeing a lot of people trying to refinance out of another private or hard money loan?
Yeah, we've seen a good bit of those. Typically, we don't like refinancing a bridge to bridge. If we do, then typically we'll require the borrower to bring some money to closing, whether that's in the form of interest reserve or just in order to pay the fees and costs of closing. But I guess it depends on the story. It depends on the asset. Depends on the leverage that was given. But we're not doing a lot of it. We do see a handful of deals though. I mean, Josh can speak to like our lead flow. I mean, we see a lot of leads. A lot. I mean, it's probably between, I'd say, 20 to 30 a day.
Yeah, at least that, and growing. It continues to grow. The trick with the bridge to bridge stuff for us is, if we like the deal, we like the deal. The problem is that if they don't have a very clearly defined exit strategy that we really believe and understand, we're not gonna touch it, because bridge is, that's not gonna work. So we know that. We'll still look at those deals, and yes, I don't know, Rock. Joe, I don't know what you think. I don't think they're any more than there used to be. I think, but we're very cautious, I would say, when it comes to looking where they came from and why they're coming to us.
So you're saying that's just not a new trend. It's always, you've always had those requests in the past.
Yeah, I would say so. I will tell you what's kind of a more newer trend, in my opinion. We're seeing more folks, and Joe can probably touch on this better than me, but that have a lot of liquidity in their properties that probably own them free and clear. We're seeing a lot more free and clear asking for financing now.
And are those cases typically where they need that money to buy other properties, or are they trying to get out of a situation with another property that they're having trouble with?
Both. I mean, sometimes they need the cash to grow their business, their current business, or they need it to buy additional properties, or they need it to clean up some bad debt or credit card debt that they had. Sometimes they're inherited properties, and kids just, while they're trying to sell or liquidate the asset, they want some short-term money.
Business loans are a big one for us. It's less expensive, less risky for them to go with a real estate loan, even on a bridge basis, to fund their business, than to go and get, a much higher interest rate on a just purely business loan. So we see a lot of that kind of activity as well. We're really, I think, overall cautious when it comes to cash out, right? We're not going to just, write a check. Here you go. Here's, $1 million and good luck. it's really understanding what is the cash for. If we can issue it in draws, we're absolutely going to do that. If it's for debt consolidation of some purpose, even for their business, we're going to go ahead and pay those bills directly. If they have a tax problem, we're going to pay that. But we do look at the asset first, right? So if we understand, look, we're 60 cents on the dollar on this building, we know we can move it quick. We know it's a non-judicial foreclosure state. We're gonna have a healthier appetite for doing that deal.
And then like when you were talking earlier about bridge to bridge, we see a lot of those, but we also see a lot of like foreclosure bailout loans, and where most lenders would probably shy away from and be scared of them. We'll look at them and we'll work with the borrower to have an exit strategy in place prior to closing. We'll even put it in our loan docs that they're required to list the property and, drop the price of it by 3% every month until it's liquidated or sold. So we'll go into riskier propositions like a foreclosure bailout loan if we can negotiate on the front end an exit strategy that makes sense for us.
Sure, makes sense. And in those foreclosure bailout situations, are those typically maturity defaults? They've run out of time with their current lender, and they just need time to sell the property.
Sometimes there are maturity defaults, but sometimes they're payment defaults, interest payment defaults too. Sometimes and these properties a lot of times, especially if we're going to do a bailout loan, have a lot of equity in them. And so we're willing to step up and help capture some of that equity for the borrower, and help them get to, sell the property so they can get back the equity they have in it.
Yeah, those deals actually typically work out really well for us, and frankly for the borrower, we'll put that right up in their term sheet and into their loan docs that, what is the list price going to be? You're going to have to drop the price in certain increments. If you got enough equity, we're going to, of course, build in interest reserve so you don't have to be making your payments during that period of time. And, they kind of know they can get out of this loan in 6 to 9 months. We are comfortable with it as well. And, if we have to take it back at that point, so be it. That's obviously not what we want to have happen, but a lot of times it ends up being a mutually beneficial experience for both us and the borrower.
Interesting. I've had this conversation with the last 2 interviews I've done about foreclosure bailouts, but I didn't think about the prospect of having an interest reserve, because the thinking is if a borrower is struggling to pay one lender, how are they going to make payments to another lender? They have closing costs. They've got all these other costs to deal with. But that's an interesting solution. Is hey, the property is going to get sold, that you're going to build in the interest reserve, so maybe the borrower doesn't have to worry about making payments. They could just focus on getting the property sold, and then everyone wins.
That's exactly right.
Generally speaking, across our portfolio, I mean, this is for me personally. I like it if we get 6 months of interest up front spread out over 12 months, that they have to make a half a payment. It lowers what their payment responsibility is, but it also puts the proof that they can make a payment. That's just not with foreclosure bailouts, but more in general. And if something goes sideways earlier on, we have enough of a reserve cushion built in to take it through a foreclosure process and continue to make payments to our investors and so forth.
Let's just talk about in general the amount of loans that you funded in, let's say, 2023 versus 2024, and what are you projecting for 2025?
I would say between 2023 and 2024, we probably funded about 50% higher than where we were. We have about $200 million actively out as a business right now. And these are all 12-month loans. So unless they're extending, we're recycling that money, and we're obviously growing and adding further loans on the books. So, I would say it's probably about 150 million we're going to do in loans this year in 2025. And I would say we've grown on average about 30% every year since about 2022.
Nice. And how about the breakdown of what, just if you were to guess, what's the percentage of commercial real estate versus residential real estate?
Pretty evenly split, I would say, frankly. Yeah, we really like the commercial side because it's income producing. We can understand it. We know how to underwrite it. And obviously on the residential side, new construction in our own backyard is something that we like a lot. And some of the luxury bridge stuff, we like that as well. So I would say it's about a 50-50 split.
it looks like the majority of your loans that you're funding, about 30% of them are in the state of Georgia, around 12% in Florida, and then the rest of the loans are in a bunch of other states. Does that sound about accurate?
Yeah, that's pretty accurate. We like to stick to the Southeast, but we'll lend all over the country.
Nice. And let's get into your lending guidelines, your program. You've touched on it a little bit, but if you could just give a quick overview of what are your preferred loan types that you'd like to do and property types, what are the loan sizes, minimum and maximum, the term, rates, fees, etc.
Yeah, I would say one of the things that kind of sets us apart from most lenders is the fact that we'll lend on almost any asset type. We don't shy away from really any property type. So we'll do residential, fix and flip, new construction, luxury rental, retail, industrial, multifamily, storage, land. We'll do new construction in all of those fields too. New construction, retail, build to suit. So we've got a huge net that we cast out. And then our loan terms are 12 months. Sometimes, depending if it's a construction loan, we'll go up to 18 with the right. We'll give all of our borrowers the right to extend as long as they're in a non-monetary default. If they're not in a default at all, we'll extend their loans. Rates typically on the low side, 11%, on the high side, sometimes 15, 16% if it's land. We charge origination points, which are between 1.5 and 3 points. And then we collect deposits on most deals. On the low end, it's $2,500. On the high end, if it's a bigger deal, it could be 50 to 60,000. Maximum leverage is 75%. We don't go over 75%. I would say our average is closer to 65%.
And what about the loan amounts? What's the minimum and maximum that you could do?
Our minimum loan amount is $350,000, and we can go up to $25 million. Our sweet spot is between 1 and 10.
Nice. And as far as well, we'll come back to the deposits, but as far as leverage goes, if you do a 75% loan to value loan, in what situation is it that high?
If it's a piece of real estate in our backyard that we understand and we can underwrite it very easily, and we know the property, we know the exit strategy, we know the borrower, it's got to have a great story. And then we would go up to 75%. But
remember, Atlanta or Georgia is a non-judicial state as well, so it gives us a little bit more flexibility here, and we can drive the properties.
Nice. And do you have kind of a general loan to value threshold for residential versus commercial, or does it just kind of depend on the deal and various factors?
It depends on the deal. If it's a new construction deal, sometimes will be 80% of cost, but it's 65% loan to value, at completion. And same thing with commercial deals. If there's a tenant involved and it's a build to suit, will sometimes be 90% of cost, which is 60% or 65% of actual value. We've got to look at the deal and underwrite it depending on the asset class.
And how about those bridge loans for luxury homes? I've seen that you guys have done a bunch of those lately. Do you have a set loan to value on those, or?
Yeah, somehow we always get stuck with the stuff that nobody else wants to do. So we've done those we're more conservative on. I mean, if it's a luxury home north of $5 million, typically we're not going to be over 60%. We don't want to, because if we went to 65 or 70%, our entire book would be luxury construction homes because everybody would be coming to us. But no, we try to stay a little bit more conservative on those just because, the risk to downside is a lot bigger.
All right. And let's get into that a little bit. As far as those luxury homes where you do a bridge loan, what are some of those scenarios? Where does someone have a luxury home that's an investment property where they need a bridge loan to cash out or to purchase that property?
So we did one in San Francisco where he was buying the new property and had a home, a luxury home that was already paid off, and he needed quick money to be able to close on the other house. So we gave him a loan in first position on the house that he had, and then we cross collateralized it with the house that he was buying, and he listed the house he moved out of and sold it to pay us off. So that was one example.
Yeah, he was with JP Morgan, and I think they had some limits on what they were going to allow him to do, and so he needed to close quickly, and we were able to do that. We have a loan closing this, I think tomorrow actually. It's a very similar situation, that they have not sold their previous house, and that's something that's coming up more and more as well. But there's an opportunity in a neighborhood. They really like the property. They don't want to lose that property, and that's something we're able to help them bridge that until they get their property sold, which will pay us off. So we'll do that. We get vacation homes. We had another one in Texas. They bought a house on a lake. I forgot the name of the lake. It's already paid us off, but same exact situation. They were in their primary residence. They were planning to move to the lake, had to sell that house. So that happens, a fair bit with us.
We're seeing a lot of luxury homes that are like 75, 80% complete, where they're coming up on maturity and they're looking to refi. We shy away from those just because it's a lot of underwriting and it's hard to get your hands around something that's mid-construction. You've got to have affidavits from all the contractors. It's just there's a lot more work that goes into it, especially if it's not something that we can jump in the car and drive to. It's really hard for us to get our hands around. So we try to shy away from those deals.
With the situation that you talked about in, let's say, in San Francisco and maybe others, where someone's moving to a new home, that's essentially a consumer purpose mortgage, right? And California does have an exception for that. And in California, it's kind of a common loan that a lot of lenders do here, where there's an exception in the California law where you can use, private lenders can do that type of bridge loan as long as the term's less than 12 months. But are you able to do those types of loans in other states outside of California, or have you done them in the past?
We don't do many of them, but the ones that we do, we make sure that they're not living in the house and that the house is listed for sale, and it's typically a second home at that point. So it's not their primary residence.
Got it. Makes sense. All right. And let's talk about some of the land loans that you've done recently, since you said that's become a common loan request that you have. If you could give us a couple of examples and tell some of the guidelines that you would have for doing a land loan.
Sure. So we did, we did a $17.5 million loan on a piece of property that was purchased by a developer who actually closed on it with a owner finance deal. They held back. They paid $23.5 million for the property. The owner held back $15 million, and it was coming up on maturity. Well, in that 1 year, the developer rezoned the property. It was zoned office originally. It was 40-acre site. He rezoned it to multifamily, townhomes, retail, hotel, and at two hotel sites. So he added, he paid $23.5 million, and with all those new uses, he added about $23 million in value. The property was worth around $45-50 million after the rezoning. So he had contracts when he came to us to refinance it. He had contracts with a multifamily developer to buy one of the sites. He had a contract, and that was for $13 million. He had a contract with a townhome developer to sell that site for $19 million. He had he was going to build a hotel, and then he had the retail portion already under contract. So he basically brought it to us, and we're going, okay, well, this is pretty easy to analyze. We see that there's exit strategies on almost every single one of these sites. If two of them sell, we're going to get paid back our loan. And so we closed it, and literally 3 months later, the apartment parcels, he sold it off and paid us down, I think, 80% of our loan. So now we've got like $4.5 million left in the deal, and the retail, I think, is the next parcel to close in the next 30 or 60 days, and we'll get paid off completely. So that's one deal where we that we just did.
And on that deal, what was your loan to value coming into the deal before he started paying off?
we had valued the property around 50 million and the loan was 17 and a half. So I don't know what that is, 33%, something, 33%, something like that. So we felt really comfortable with the deal, and we knew it was a clear exit strategy. It was a developer that had done it before. So it was a good story behind it.
And was there any debt on the property that you refinanced?
Yeah, so they had, when they closed on the property, they had the original owners hold back a note for 15 million. They brought 7.5 million to closing, and then the original owner held back 15. That's who we refinanced. And then we bumped the loan to 17.5 to cover interest reserves and closing costs and whatnot. But we didn't give them any cash out. That was just to cover most of the cost of the loan.
Nice. Any other land deals that you can tell us about?
Yeah, Joe, we had the one on Wind Drive as well, down in Hampton.
Yep, we had a big 520-acre site in South Georgia and Hampton, Georgia, that was same sort of situation. There was a loan on the property by a previous owner, and the developer went and rezoned it. He zoned it for 1,000 single-family homes. I think 600 units of apartments, retail in the front. He had a big anchor with a grocery store, and he had another site that was industrial that he teamed up with a data center developer and sold part. I mean, so basically it's like the same story. He was flipping out parcels to pay us down. It was a $10 million loan on a piece of property that we valued at 40 million. So our loan to value was great. And we've already been paid down 5 million because he sold a parcel to a data center developer. And we're sitting on, I think that was 70 acres of the 500. So we've still got 400 acres of collateral that we've got 5 million of debt on.
Yeah, and even though it's in South Georgia, it happens to be in a great area. There's a ton of development happening down there. It's, people that want to look down there, it's a little less expensive and so on.
And today we closed a deal in Prosper, Texas, which is another land loan. It was a developer is having trouble getting his permits. There's some right-of-way that the city's taking, and so he had to finish negotiating the right-of-way and closing that before he could move forward getting his permits. He had already graded the property. He had, I think, $1.5 million in debt. The appraisal came back at 7.8. And so we refinanced his debt on that deal and gave him a little bit of interest reserve so he could get through the process. The right-of-way was actually closing at the same time, simultaneous close, so that now he can get his permit to start work and get us refinanced with a construction loan.
And Prosper is a quite a booming area. I visited there a few months ago, and the amount of home building that they've got going on there is quite incredible.
Oh, really? I didn't know people visited Prosper, Texas.
It's just north of Dallas. So while I was in Dallas, a friend bought a house out there within the last 2 years and showed me the area.
Oh, great.
Yeah, but you can see, like with Joe's story of all three of those land loans, clearly defined exit strategies or pay down strategies, clear loan to value, but if we probably see seriously at least 50 land deals a week that we just, we shy away from. We're very particular. So it's going to have to be a deal like one of those for us to get excited about it.
And I like land because I at heart, my background is in development. So I like underwriting land deals.
Nice.
So I get excited to talk about them.
Yeah.
I don't like talking about a fix and flip or a $300,000 new construction, but I'll talk about land all day.
Nice. Love it. And that is quite a unique offering. Even the few lenders I know that do consider land, it's very localized to where they live and operate and work. But to do these larger land deals is quite unique. And when you do these land deals, are you typically asking for additional collateral?
Sometimes. I'm trying to think the last time we did a land deal where we required it.
We've taken extra parcels elsewhere to make the numbers work, just to have more security, for sure. Listen, if we can get it, we're going to take it.
Sure.
Yeah.
Makes sense. And on other bridge loans that you do outside of land deals, do you do a lot of cross collateral?
We do. Yeah. Um, it helps to make the numbers work. Whenever possible, we'll cross up other properties, and try to get to the number that they need to get out for sure.
And is it ever possible to cross collateralize in second position?
Yeah. So we'll take a first on the primary property, and then we'll take a second on something else that they have, as long as the combined LTV on that second doesn't exceed 65%, and we obviously have to like the property.
Yeah, we're doing a deal like that right now in South Carolina. They're repeat borrowers, but it's a little bit out of our comfort zone because it's a special use. It's a bed and breakfast, and they've got 7 or 8 different buildings in the market that they own and operate either a restaurant or another bed and breakfast out of. And so we're doing a blanket second mortgage on all of their other assets and a first mortgage on this one.
Yeah, it's actually I think it's Wilmington, North Carolina. It's
Oh,
a great
sorry,
market.
North Carolina. Yeah.
Yeah, it's a great market over there. These guys, we like them as borrowers. They exited well from our first loan we did with them, and they really believe in that market. They moved down from New York. They bought a bunch of other real estate down there, and we were able to get them what they needed to get us comfortable. Yeah, like Joe said, we cross collateralized 3 or 4 other properties outside of the main one that they needed the cash for.
They've got a proven track record in hospitality, and a lot of active businesses that they're managing. So we took a special risk just for them because of their backgrounds and experience. But typically we don't love doing restaurants and small hotels like that.
Do you like larger hotels?
We do. Hospitality is the one thing that we don't have a strong background in, but we have partners that understand it and own it. And so we always bring in one of them to help us underwrite those deals. And sometimes they'll participate in the loans with us. But yeah, we don't shy away from hospitality. We look at a lot of deals. We've probably closed 3 or 4 in the last 12 months.
Nice. And how about some other unique situations? Do you consider foreign nationals, for example?
Yeah, we've done foreign national deals both here in Georgia and Florida as well, which kind of makes sense, I guess. Um, but yeah, as long as they can show liquidity, and those are more on purchases, I would say, frankly, than a cash out refi. But yeah, we like those deals.
And I'm assuming the loan to value is typically lower on those when it's a foreign national.
Yeah, it is.
All right. And how about recourse? Do you ever do any non-recourse loans?
Yeah, we
Not,
will.
yeah, go
I
ahead.
mean, very rarely. I'd say 90% of our deals are full recourse. If we do a non-recourse, it's because our loan to value is just so low that we don't think there's ever going to be a need
Yeah, or
for
we'll
the
do like a
recourse.
corporate guarantee. Um, we'll try to get some pledges of stock. We'll try to do something else to make up for that. But yeah, it has to
If it's
be.
non-recourse, we're going to have a bad boy carve out in
Yeah.
there.
Sure, makes sense. All right. And then let's talk about rehab and construction projects. Do you do any rehab value add deals that are not ground up?
We do, but it's hard for us to compete because it's a saturated market with lenders that are chasing, fix and flip deals, and typically it's below our where we where we like to be on a loan amount. We'll do them, especially if we can get them in Atlanta, and it's close by to us. But we don't do much of them just because we can't compete with 90% of purchase or 100% of purchase and 100% of rehab costs.
And the rates are just, driving to the bottom. So, we're a balance sheet lender, right? So a lot of these guys will do this because they can sell those loans off or whatever they need to do to operate their business. But like Joe said too, like, we'll do higher end value added fix and what $1 million plus house if we like it and understand it.
And how about commercial properties? Do you do any value add on commercial?
Yeah, we do value add on retail. Somebody's buying a retail center that's 50% vacant and they want to fix it up and try to re-tenant it. We'll do a loan on that. We're working on, new construction, storage deal.
Storage, retail, industrial, basically. Not hospitality. we want that thing to be up and running and have good numbers behind it if we're going to hold down.
Yeah, we haven't done much office, but we're not. If somebody's got a value add office deal where they're buying it at pennies on the dollar, we're not. We'd look at a deal like that.
And what's the typical leverage on a deal like that? What's the loan to cost and loan to after repair value?
Yeah, it's going to depend on. Office is just such a hard asset class to underwrite today because really you don't know what your leasing activity is going to be like. You don't know how much TI you're going to need to have to give, an office user to come into the market and lease from you. So they're really hard to underwrite. We're going to be extremely conservative on them, probably 50% of cost.
And what about the other asset classes like retail or industrial?
Retail we'll get more aggressive on. We'll go up to 70% probably. And then we'll fund some of the build out if it's needed or some of the renovations, probably 80% of that.
Yeah. And like Joe had mentioned earlier, if it's build to suit, like we did about 14 mobiles last year for a T-Mobile developer. We can get more aggressive on there too because there's a clearly defined exit and good experience with them. We'd rather do that all day long than do a $200,000 fix and flip, frankly.
Nice. All right, let's talk about valuation. What's your process for valuating a property? Are you doing it in-house or do you require formal appraisals? And let's just focus on commercial real estate or larger residential deals.
Yeah, typically we'll run our own underwriting in-house through different softwares that we use like Crexi or FMLS or MLS or whatever softwares we have available to us. And then we'll come up with what we think the value is, and then we'll compare that to whatever the appraisal comes back at. Sometimes if it's in our backyard and it's a quick close, we don't require the appraisal. We'll just get a broker's opinion of value because frankly, we believe the broker who is in the market selling this product knows better what it's worth than an appraiser who maybe isn't in the market, right? So we really lean mostly on our internal review and then a broker's opinion of value, and then we compare it to the appraisal if we get one.
And we've developed some really nice relationships with some brokerage firms as well, like Matthews or Marcus & Millichap. They're down the street from us. And so we can get some of them to really give us some guidance. And frankly, funny enough, a lot of them will look at the deals and they like the deals and they're like, hey, we want to throw a couple of dollars in this deal, which that obviously makes us feel more comfortable all the time whenever that happens. So that's a big one.
And then if it's an asset class that maybe we don't understand 100%, I think I spoke to this earlier, but like hospitality, we've got investors and owners in that asset class that will help us underwrite the deals. And we have investors that are in the storage, that are storage developers, so they'll help us underwrite storage.
Nice. And how about site visits? I've seen some videos on social media of you guys flying out in a little plane to go visit a property.
Yeah, Josh will fly us right into the front door.
Yeah, Rocky. Yeah, wherever you want me to fly you, I'll take you. Yeah, we absolutely. If it's in the Southeast, we're gonna go put eyeballs on it. If it's a larger deal somewhere else, we're gonna put eyeballs on it. We're gonna send somebody to that. Pretty much every deal we do, we're sending somebody to physically go look at it, even if it's not someone in our office, if it's a trusted partner or broker, or we have a friend that lives in the neighborhood or whatever. We're looking at we're looking at everything.
All right. And then the ones that you personally fly to, what's the region? What's the coverage area? Can you fly to North Carolina, South Carolina?
Yeah, I mean, listen, if it's a cool vacation spot and there's an excuse, we did a deal in Montauk recently. I'm going up there at the end of the month, so I'm going to go to the shopping center and check it out. That's a little far, but yeah, North Carolina, South Carolina, Florida, Southeast, Atlanta, obviously. We'll go fly and take a look at it for sure if we need to. Louisiana.
So how does that work? You fly in. There has to be a small regional airport fairly close to the property. Does the borrower come and pick you up?
It varies. Yeah, they'll pick us up. But there's a guy up in Calhoun, Georgia, it's kind of funny that I flew there, but it was a 10-minute flight. With traffic, it could be an hour and a half drive, even though it's not that far. But we bounced up there, and our borrower, great guy, he picked us up. We did a loan on 2 industrial buildings. His primary building, he runs ammunition business. He makes gunpowder for ammunition companies. His secondary property that he needed a loan on, he has these old 1960s Paris jets up there and he's selling them. That's how he's going to pay us off on that property. So, he was just a good old boy. And he picked us up and drove us around and showed us everything. And there's really no better way, honestly, to know you're going to like the deal than getting face to face with your borrower and having them share their passion about the project. You see that, you're like, all right, I believe in this guy. I see what he's doing and I see what it looks like. So we'll do that if we have opportunity for sure.
Nice. All right. With that, let's take a break and we'll be right back. Support for the show comes from Ross Diversified Insurance Services. All real estate investors and all private mortgage lenders need insurance. More specifically, they need the right insurance partner. For over 35 years, Ross Diversified has been the trusted partner for over 3,000 property investors and 500 lenders throughout the United States. If you're a real estate investor, Ross Diversified can help you whether you're managing a single rental property or a large portfolio of rentals. And if you're a lender, Ross Diversified can protect you with force-place insurance for when a borrower's policy lapses, or with REO insurance in the case of a foreclosure. They offer competitive rates and hassle-free claims assistance. Licensed in all 50 states, Ross Diversified understands the unique challenges of real estate investing and provides customized solutions to safeguard your assets. Visit their website, rossdiv.com, to learn more and request a quote. That's ROSSDIV.com. Please mention that you heard about them from LenderLink and the Private Lending Insights podcast. All right, and we're back with Josh and Joe from Yieldi. Let's talk about your company. Tell us a little bit about your operation, the number of people, a little bit about the history, and anything else you could share with us.
Yeah, the history is the fun part, I guess. So Joe, as you probably can tell from a lot of this podcast, he's got a significant wealth of real estate development. He's third generation, been doing this for a very long time from different aspects. My background is in technology, so anything to make us efficient, which goes to kind of the size of our company. But Joe and I met at 6 o'clock in the morning at a gym. We were outside. The trainer was late, and we were running around the building and started talking to each other, both annoyed at the trainer for not being there on time. And Joe was telling me what he did, and I was telling him I had just sold my last technology company and was lending money. And, from there we developed a great friendship and then eventually a business. What makes us unique, I think, is, we're a balance sheet lender first. And we used our own capital. We continue to use our own capital every day. So we're very hands-on with everything from origination through servicing in-house. And we grew the business through friends, really through family first, tested what we're doing through friends after that. And then it's all sort of been word of mouth. And only recently, actually, we started to do some marketing to expand outside of our own sort of friend and family network to continue to grow the business. Joe kind of add on to that.
Yeah, so I started with a REIT buying mortgage-backed securities. So I started analyzing risk. And then I got into development, and we were building a lot of grocery anchored shopping centers. So out of analyzing risk into taking risk, now back to analyzing risk and doing lending again, which is a lot easier than development. And like Josh said, with his technology background, we've been able to grow the business with a small team. We've got my brother Chris, who is the head of originations, and he's got 3 originators that work under him, and they analyze and look at every deal. Josh and I service the loans, handle the books, and we've got a closing title girl, Heather, who is kind of the glue that holds everything together. And she's got a wealth of knowledge in the industry and title work, so she helps a lot. But that's the team. It's like 6 or 7 of us.
Yeah, the cool thing that's happened, just timing being what it was when we got into the space back in 2019, a few things have happened that really have helped us to be able to stay lean. One of which is sort of standardization of the docs companies like, Lightning Docs and Go Docs and these guys. They help us to be able to really scale. With Heather being in here, obviously, to help manage that process. And lately, over the last 2 years, we've taken a deep dive and putting a good amount of money and time into AI. And we think over the long term, It's going to help us to be able to scale the business, to handle more leads, close more deals, service them, and so forth. So we're really long on the business and obviously long on the technology side to help us scale the business.
Nice. And tell us about the capital. How's your capital structure work, and what's your model essentially when it comes to capital and recapitalizing?
Well, we'll take anybody's capital. No, just kidding. So, I mentioned earlier, we started with just our capital. And so the way our business model works effectively is, we have retail investors, high net worth individuals. They must be accredited investors. Gerasi helped us set up our fund back in 2019. And we use an instrument called a borrower payment dependent note, or a BPDN, which effectively is a promissory note that allows us to fractionalize the loans, and put the borrowers into those loans. So, the way our capital cost works is we'll take whatever the loan amount is, and typically we're making a 2.5%, 3% spread on what we're servicing the loan at and what we're paying out to our investors. Effectively, we've got about $200 million out, like I said, right about these days, and just growing the business sort of organically that way. We have no debt on the books at this time.
And are you typically putting your own money into every deal?
Yeah, we co-invest in every single loan. We started the business with just our own capital to put it to work, and then it was really a litmus test. We did it for about a year and a half, and realized, wow, this is working. Let's bring in some family that want to invest alongside us, and then we opened it up to outside investors. And really, the growth has just been word of mouth. We've never missed a payment to an investor, even if a deal goes south. We just deal with it. We pay interest current, and then we deal with getting our hands around the property if we need to, and selling it, reimbursing ourselves.
Nice. All right, let's switch gears a little bit and talk about geography. What are some of your favorite states to lend in?
Atlanta, Georgia.
That's it. Yeah, I have a map over my head. I can show it to you more clearly if you want to see
Yeah.
it. But if it's non-judicial, we love it. If it's judicial, we'll do it, but not love it as much.
Yeah, but we lend a lot in Atlanta, a lot in Florida, Texas, North Carolina, South Carolina,
Tennessee, a lot in the South.
Tennessee. Yeah.
Texas, we like a lot though, for sure, like Joe said.
And then we've done a lot of loans in like high-end vacation areas like Aspen, the Hamptons, where Salt
Deer
Lake
Valley.
City, Deer Valley, Park
Yeah.
City.
Interesting. And speaking of Park City, Utah has a lot of regulations. How about lending in Western states? Is that something you're able to do? Do you have to have a local broker involved in those deals?
Yeah, we buy by whatever the local laws are as far as broker licensing and those sorts
80%
of
of our deals typically come from brokers. So we've got a really strong broker network. We take care of our brokers too.
Nice. And
Hopefully they like working with us.
I'm sure they do. Are there any particular regions that you avoid, like let's say the New York metro area?
New York, California.
Alaska and the Dakotas.
Yeah, just because New York and California is so borrower friendly on their laws. We don't want to get into a situation where, we get in business with a bad actor, and next thing you know, it's been 7 years and we still can't get to the real estate or get our money. We've heard too many horror stories.
Sure, makes sense. Let's talk about Georgia a little bit. Within Georgia, there's obviously Atlanta Metro. Do you consider properties in other parts of Georgia outside of Atlanta?
Yeah, for sure. Savannah's a great area. It's a great market. We've done a bunch of stuff there. Augusta, obviously, the Masters is there. Outside of Augusta, there's a couple little pockets like Aiken and Evans, and in Atlanta, everything's called Atlanta Metro. But if you'd really take a deep dive into it, there's a million little suburbs all over the place. And so we've got deals right now that we're working in the pipeline in Acworth, Alpharetta, Roswell, Flowery Branch, really all over the place.
Yeah, Georgia's got the most counties of any state. So, and Georgia grows like this. I mean, Atlanta's like, it grows outward. There's nothing keeping it, there's no body of water or anything. So we'll grow with it. And we like going to the suburbs and doing deals outside of Atlanta because there's so many growing markets and little pockets that we like to invest in.
Are there any challenges within Georgia in terms of municipalities that you have to deal with that might have certain regulations that others don't?
Oh, municipalities are all a pain in the butt. I don't think there's one that's easy to deal with, but that's why I like the lending side because we don't typically have to deal with them. Somebody else, the developer, whoever the property owner is, has to deal with it. And by the time they bring it to us, it's already bowed up and it's nicely presented to us with everything done. But yes, to answer your question, if we have to, it is tough dealing with a lot of these municipalities. It's just inefficient, takes forever. You think you're going to get permits or something done, something else pops up. There's a stream, you got to go through a stream buffer variant. I mean, all kinds of stuff comes up as that the developer has to work through.
And what about foreclosing in Georgia? If you have to take back a property, is it fairly easy to do?
Yeah, it's a non-judicial state, so you have to advertise for 30 days, and then on the following Tuesday, the next month, you can foreclose. So it's usually a 60-day process.
Yeah, Tennessee's the same way, so we like those. Texas is similar. That's why we'll get a little more aggressive in Georgia and some of these other states that are like that. Florida's a huge pain, but we understand the value what we're lending on, and we take that into account when we underwrite.
All right. Sounds good. All right, gentlemen, that's all I had on my list. Was there anything else that you wanted to add?
If you're an investor looking to invest in loans, give us a call. Josh and I would love to talk to you. If you're a borrower and you're looking for money, reach out to us. We answer emails and phone calls every hour on the hour, so we'll get back to you very quickly with an answer.
All right, gentlemen. Thanks for your time. We'll see you soon.
Thank you.
And that's a wrap for this episode of Private Lending Insights. Yieldi is listed on privatelenderlink.com. They've been on there for over 5 years. I'll put a link to their profile in the description. You can also find them by searching on the site. They're listed in most states in the South, Southeast, Midwest, Northeast. Check out their profile to learn more about their guidelines and find their contact information. You can call them, send them a short email form, or a long loan request form. When you reach out, please be sure to tell them that you heard about them from LenderLink and the Private Lending Insights podcast. I hope you found this episode to be insightful. Thank you for tuning in and listening all the way to the end.